The year 2022 is not looking good for the stock market. The combination of rising inflation and decreasing economic development has made investors anxious, which is a sentiment that is very understandable given the circumstances. The returns that were historically generated by market winners like technology and aggressive growth stocks are just not being generated now to the same extent as they once were. Despite this, a significant amount of study in economics has demonstrated that over the course of a longer period of time, equities still tend to outperform the majority of the other major asset classes. Even when the market is going through a rough patch, investors should fight the impulse to exit the market entirely. Here are 8 dividend stocks to buy. Number 8. Exxon Mobil Corporation. In 2022, the stock market has seen very few positive trends overall, but the energy sector has been one of the few exceptions. In recent weeks, natural gas prices have reached their highest levels in a decade. Although it has decreased somewhat from its springtime high, the price of a barrel of crude oil is still very close to $100, which is a significant increase from where it was trading in recent years, even in the year 2020, when many of its competitors were forced to reduce their dividends. And today, as a result of the recovery of the industry, it is bringing in record earnings. After the significant gain it has had over the course of the past year, investors may believe that it is now too late to purchase shares of Exxon. However, despite this, shares are still available for a price that is lower than 8 times forward earnings while still offering a dividend yield that is 3.6%. Number 7. Shell Group. Shell, much like Exxon Mobil, has transformed into a cash flow machine as a direct result of the rise in the price of energy. The profit that the corporation made during the second quarter skyrocketed to $11.5 billion, which is a significant increase from the $5.5 billion that it made during the second quarter of 2021. The amount of free cash flow generated by the corporation was over $13.7 billion, which is about double the amount reported during the second quarter of 2021. During the quarter, Shell returned $7.4 billion to shareholders in the form of dividends and buybacks of existing shares of the company's stock. Shell's total market capitalization is under $200 billion at the moment, despite the fact that the company is on track to generate approximately $50 billion in annualized free cash flow, and despite the fact that its shares sell at an estimated 5.3 times forward profits. In addition to the substantial share repurchases, the company's stock is also generating a dividend yield of 3.6%. Number 6. Unilever plc. Unilever, a corporation that specializes in packaged foods and consumer goods, is currently in an intriguing situation. Because of shifts in consumer preferences over the past few years, the company has had a difficult time achieving considerable growth in its revenue. However, due to the inflationary atmosphere that exists now, things are different. The most recent quarter for Unilever experienced revenue increase of about 9%, which is a significant improvement from the company's historical record. Price increases were the only factor at play here because there was no growth in overall sales volume. At the moment, Unilever is experiencing a decrease in its profit margins due to the fact that the rate of inflation in its costs is greater than 9%. However, over time, inflation should become more manageable, and Unilever should reap the benefits of price increases it has already implemented throughout the supply chain. Unilever is headquartered in Europe, and as a result, its shares are currently trading at a discount. The discount is in part caused by the recent drop in value of European currencies in contrast to the dollar. American investors also stand to benefit from this situation. At the moment, the yield on the shares is 4.1%. Number 5. Walgreens Boots Alliance. The Walgreens Boots Alliance is experiencing a challenging time right now. The company's management was disappointed that the Boots acquisition in the United Kingdom did not turn out as expected. In the meantime, Walgreens' sales trajectory has been trending downward following the stronger period it saw during the peak of the pandemic. Additionally, there are longer-term concerns regarding a reduction in the company's convenience retail section of outlets, as well as uncertainties around prospective changes in the pharmacy business. This is because the government and insurers are attempting to curb cost rises. These are all reasonable points of contention. On the other side, Walgreens' forward earnings multiple has dropped to 7.6 times. In addition to this, it has proven to be extremely dependable over the course of the years. Walgreens has increased its dividend payment for the past 46 years running, and the stock currently yields 5.3%. Number 4. Life Storage. During periods of inflation, real estate investment trusts, sometimes known as REITs, can be profitable investments. This is especially true for business owners of self-storage facilities like Life Storage. In most cases, storage spaces are rented out on a month-to-month basis. As a result, owners have the ability to immediately increase costs in response to shifting market conditions. In addition, these types of companies often do not need a large number of employees to function, which means that the effect of inflation on labor expenses will be minimal. In order to finance their holdings, REITs typically have a large amount of long-term debt on their balance sheets, which can be viewed as a positive during times of rising inflation. The state of the economy has been extremely beneficial to the storage industry, which has seen enormous growth as a result. In August, Life Storage made an announcement that their previous quarter had been phenomenal, with profitability and revenues significantly above forecasts. Additionally, the company projected an increase in revenue from its existing stores of about 14%, which was a significant improvement over its previous projections. There is also positive news for those who focus on income, since Life Storage has recently increased its dividend to 3.3%. Number 3. The Southern Company. The Southern Company is undergoing significant change as a power utility. In the past, Southern generated the vast majority of its electricity from coal. However, in recent years, the company has shifted its focus to natural gas, nuclear power, and alternative energy sources. The construction of several of these new generation facilities, such as Southern's nuclear power stations, has been marred by huge cost overruns. Recent months have been difficult for the solar sector on multiple fronts, including supply bottlenecks and concerns around cost. On the other hand, the enactment of the Inflation Reduction Act, which incorporates large incentives for renewables, ought to provide Southern with a sizable head start on this front. In a broader sense, Southern does business in a number of markets that have robust populations and regulators who have a perspective that is typically positive for the utility industry. The shares of Southern Company were recently upgraded by UBS as a result of good regulatory action on the company's Vogtle Unit 3 nuclear power plant. The dividend yield on the stock is currently 3.5%. Number 2. Verizon Communications Incorporated. Historically speaking, the telecommunications industry has shown to be one of the most consistent places to find high dividend equities. However, following AT&T's unexpected dividend drop from the previous year, some investors have chosen to withdraw their capital. One could argue that Verizon has been unfairly punished because of its association with other companies. The corporation did not waste as much money on dubious acquisitions as AT&T did, and did not take on nearly as much debt as that company did. In response to intensifying competition and the high cost of rolling out 5G, Verizon has indeed witnessed a slowdown in the development of its profits. Nevertheless, Verizon's balance sheet is in good shape, and the company's profits, while not exploding, are consistent and easily support the dividend. To put it another way, AT&T will not be replaced by Verizon. In the meantime, Verizon stock is currently trading at a price that is lower than 9 times its anticipated earnings and offers an attractive dividend yield of 5.9%. Number 1. Suncor Energy Company. Suncor is not simply another huge energy corporation. It is unique in many ways. Suncor's fortunes aren't solely related to the raw price of crude oil because the company owns a considerable quantity of oil refining and distribution assets. This means that Suncor's stock price is more stable, and in that regard, refining margins have soared to historic levels this year, adding to Suncor's operations' overall profitability. Another significant benefit that Suncor has is its dominant market position in the oil sands of Canada. Once they are operational, oil sands are assets with a long lifespan that can continue to produce at a steady rate for decades with little to no noticeable decrease. In a world in which governments and investors with a concern for the environment have imposed severe restrictions on new oil production assets, Suncor's existing output that is already in operation stands out as a significant source of competitive advantage. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.